It's hard to breathe, but that's alright. Hush.
Hey, what's going on, guys? Welcome back. So moving on to accumulation schematic, we have phase A. I'm going to quickly go over the phases. I'm going to explain what these mean. So, PS, SC, AR, but I'm going to just, simplify them into modern currency trading, right? So phase A, as we can see, this is where the selling force decreases and the downtrend starts to, slow down. This phase is usually marked by an increase in trading volume. So the preliminary support, as you can see, the PS, that indicates that some buyers are showing up, but still not enough to stop the downward move. Now moving on to the selling climax, that's formed by an intense selling activity as investors capitulate, and this is often the point of high volatility, where panic selling creates big candlesticks and wicks. Now the strong drop quickly reverts into a bounce or automatic rally to the AR, as the excessive supply is absorbed by the buyers. In general, the trading range, or the TR, of an accumulation schematic is defined by the space between the SC low and the AR high. So this is your I suppose you could call it in simple terms, support and resistance, right? Now moving on to phase B, we have, based on the Wyckoff's law of cause and effect, phase B may be seen as the cause that leads to an effect. Essentially, phase B is a consolidation stage in which the composite man accumulates the highest number of assets, and during this stage, the market tends to test both resistance and support levels in the of the trading range, so the TR. Now there may be numerous secondary tests during phase B. However, in some cases they may produce higher highs, bull traps, and lower lows, bear traps in relation to the SC and AR phase A. So pretty much it's just liquidity sweeps within the phase B, right? Because obviously, like I said, you may see further secondary test. What I'm saying that is, you're going to see this test below the SC. You may even see a test above the AR, right, or even this high. So that's where you will see the sort of the highs and lows of the range, and again it's just breaking to the downside and liquidity sweeping, taking out the buys, and that's where the classic manipulation starts to happen, right? Moving on to phase C, a typical accumulation phase C contains what is called a spring. It often acts as a last bear trap before the market starts making higher lows. During phase C, the composite man ensures that there is little supply left in the market, i.e. the ones that were to sell already did. Now, the spring often breaks the support levels to stop out traders and mislead investors. We may describe it as a final attempt to buy shares or currency at a lower price before the uptrend starts. Now, the bear trap induces retail investors to give up their holdings, and in some cases, however, the support levels manage to hold, and the spring simply does not occur. In other words, there may be an accumulation schematic that present all other elements, but not the spring. Still, the overall scheme continues to be valid. Then moving on to phase D. The phase D represents the transition between the cause and effect. It stands between the accumulation zone, so phase C, and the accumulation breakout of the trading range, so phase E. So it's just in between those two ranges. Typically, phase D shows a significant increase in trading volume and volatility, and it usually has a last point in support, so LPS, as you can see, making a higher low before the market continues higher. Now, the LPS often precedes a breakout at the resistance level, in which turns create high highs. Now, this indicates sign of strength, so SOS, as previous resistance now becomes brand new support. Okay. Now, despite the somewhat confusing terminology, there may be more than one LPS during phase D, and they often have increased trading volume while testing the new support lines. In some cases, the price may create a small consolidation zone before effectively breaking the bigger trading range and moving on to phase E, which is where we look to capitalize on that move, right? Now, if we just cover phase E, so phase E is the last stage of an accumulation schematic. It is marked by an evident breakout of the trading range, caused by an increased market demand, and this is where this is when the trading range is effectively broken and the markup or bullish uptrend starts to kick in, right? So that was pretty much accumulation. It's very simple. You've got the phase A, which sets the support and resistance for the range. Then phase B, you usually will see the bull trap and bear trap, and all that's doing is just taking the liquidity. Then phase C, we usually see the spring or the shakeout to the downside, and then you should start to see the beginning of the uptrend. Then as we move into phase D, that's when the price is starting to break above the trading range and seeing that sign of strength in which price is going to continue to head to the upside, I guess, right? So I'm going to jump onto distribution schematic into the next video. But other than that, it's been a 5-minute video on accumulation. I hope you've enjoyed this one, and I'll catch you on the next one.